So, imagine you're sitting in the back of a commercial flight. You happen to glance up into the cockpit, and you see the pilot realize the fuel gauge is totally broken.
Oh, wow.
Yeah, right. But instead of, turning the plane around, the pilot just takes out a Sharpie, crosses out the empty reading, draws a line near the top that says full, and just goes to sleep.
That is, I mean, that's a terrifying visual.
It is. But imagine that pilot is the global financial market, and your pension, your investments, you're strapped into the back of that exact plane.
Well, the scary part is it's mechanically identical to what's happening in the global economy right now. I mean, the instruments are absolutely screaming that something is fundamentally broken, and the markets are just drawing a new line with a marker.
Right. Which brings us to today. Welcome to the Deep Dive, everyone. Today we're tearing into a really fascinating and frankly pretty alarming financial dispatch. It's dated May 17th, 2026, and it's called The Communique and the Conflagration.
Yeah, quite a title.
For sure. Now, if you follow global news, you already know that a massive, highly anticipated summit between Trump and Xi just wrapped up in Beijing, right, on May 15th and 16th.
Right.
And if you looked at your portfolio this week, you probably saw a sea of green. The markets breathed this massive sigh of relief. Spreads tightened. Everyone basically looked at the photo ops and assumed the geopolitical nightmare, the whole Strait of Hormuz closure, was finally settling down.
But our source material today argues that this market reaction is a historic, catastrophic error.
Yeah, it really doesn't hold back.
It doesn't. Because we aren't here to talk about what the summit accomplished diplomatically. We're looking at what it completely failed to resolve in the physical world.
Exactly.
The market is pricing in this massive diplomatic victory while just blissfully ignoring three major structural breaks in the global economy.
Which means, if you have money in the market, or if you're just curious about how entire systems of supposedly brilliant institutional investors can be dead wrong all at the exact same time, this deep dive's going to map it out for you.
Yeah, so let's start with that massive disconnect between the feeling of safety in the markets and the actual physical reality of global supply chains.
Right, because the FT, the Financial Times, called the Trump-Xi meeting a summit of low expectations that at least restored some stability.
Exactly, and the market received precisely the narrative it wanted, right? The tone was measured, you had some symbolic agricultural purchase commitments, and an implied freeze on any further trade escalation.
Which gives investors the story they want to hear.
Right. It allows them to say, the trade war is contained, emerging markets are safe again, and the geopolitical risk premium can finally compress.
But the author of this dispatch, who is a sovereign credit analyst, by the way, makes a really crucial distinction here.
Yeah, they do.
A credit analyst's job isn't to read diplomatic tea leaves, right? Or care about smiles at a press conference. Their job is to track the physical movement of stuff. Goods, energy, raw materials.
And the physical reality here is totally disconnected from those signed papers. Take the fuel situation. The diplomatic narrative was that Beijing explicitly signaled they would ease their export ban on refined fuel. So the market took that as gospel, like, okay, the crisis is easing.
But then you look at the actual shipping data.
Right, the physical ships moving across the ocean. There has been zero actual rebound in shipments to Asian economies.
None. Like literally 0 barrels moving to economies that are absolutely starved for energy right now because of the Iran war.
Yeah, the physical flow just isn't there.
And the dispatch points out something even crazier. A vessel was seized off the coast of the UAE, heading for Iran after the summit concluded.
After the handshakes.
Exactly. The ink is barely dry on this supposed diplomatic stabilization, and physical ships are still being taken in the world's most critical energy corridor. It's like two neighbors sitting down for a very polite, constructive mediation over where to put the property fence, completely ignoring the fact that their shared house is currently burning to the studs.
That's a great way to put it. The diplomacy works, sure, but the structural supply disruption isn't fixed by a handshake.
Right, a handshake doesn't put out a fire.
No, it doesn't. You cannot paper over a physical shortage of refined fuel with a constructive tone at a summit. If a factory in Asia doesn't have the diesel to run its generators, a communique from Beijing doesn't turn the lights on.
Yeah.
The market is pricing in a return to normal, but the physical supply chain is screaming that normal is gone.
And when physical energy gets constrained like this, the immediate result is inflation. Everything costs more to make, More to move. So if energy shortages are the fire, inflation is the smoke filling every single room of the global economy.
Right, which brings us to the first major structural break the market is ignoring, that inflation is fundamentally. And to understand why this is an earthquake, you have to look at the behavior of Japanese fund managers. The dispatch emphasizes that these managers are now explicitly communicating that they're going to sell US Treasuries to buy domestic Japanese bonds.
They call it the repatriation thesis, right?
Exactly. And the author notes this isn't just some theoretical risk anymore. It's not a white paper debate. It is active positioning by massive institutional funds.
Okay, but here's where it gets really interesting, and I need you to connect the dots for me here. Why does a fund manager in Tokyo selling U.S. Treasuries spell disaster for a country like Kenya?
It's a great question. To grasp the magnitude, we have to look at the carry premium. Let's break it down simply. For a very long time, interest rates in Japan were effectively zero.
Right, super low.
So if you were a Japanese pension fund sitting on billions of yen, you couldn't make any money leaving it at home. So you converted that yen to US dollars and bought US assets like treasuries or corporate bonds that paid a nice, safe return.
So all that Japanese wealth flooded into the U.S. dollar system.
Exactly. It basically created a giant multi-trillion-dollar reservoir of cheap, available cash floating around the global financial system.
Wow.
Now, who relies on that reservoir of liquidity? It's not just the U.S. government. It's high-yield emerging markets. Countries like Pakistan, Egypt, Kenya, and Ethiopia rely on issuing sovereign debt that is ultimately bought up by investors tapping into that massive pool of dollar liquidity.
Ah, I see. So if I'm understanding the chain reaction here, now that inflation has finally forced Japanese bond yields to spike to record highs, those fund managers don't need to take their money halfway around the world anymore.
They don't, especially when you factor in the cost of hedging against currency fluctuations. If they can get a competitive, safe return sitting right there in Tokyo, they are going to take it.
So they sell their U.S. assets, convert the dollars back to yen, and buy Japanese bonds.
Yes, the capital goes home, which means that giant reservoir of global liquidity just starts draining.
And if you're an emerging market like Kenya or Egypt, the cheap funding you need to keep your country running is suddenly vanishing. Your borrowing costs just skyrocket.
Almost overnight, yeah. And the dispatch also mentions some wild political drama happening in Japan, making this even worse.
Oh, right. Takeichi's advisors.
Yeah, Takeichi's economic advisors are actively pushing back against the Bank of Japan's attempts to taper its policies. It's complete political incoherence.
Right.
You have the central bank trying to manage this explosive inflation and the political establishment trying to fight them. But the author makes a very cynical, very accurate point. When political signals and market forces collide, the market wins. The yields are staying elevated.
The capital is going home.
Yeah.
And for anyone listening who thinks, well, I don't live in Kenya or Japan, why does this matter to my wallet? Think about what happens when one of the biggest buyers of U.S. debt suddenly stops buying and starts selling. Less demand for U.S. Treasuries means the U.S. has to offer higher interest rates to attract buyers. That bleeds directly into U.S. mortgage rates, auto loans, corporate borrowing. It slows down the entire machine.
It absolutely does.
But let's follow that draining reservoir of capital for a second. Because if all that money is packing its bags and leaving the emerging markets, who is the first one left dying of thirst? That takes us to the internal collapse of vulnerable economies, specifically Turkey.
Yeah, Turkey's situation this week is the perfect illustration of how external shocks, so the energy crisis and the capital drain, cause domestic economic frameworks to simply snap.
Right.
Let's look at the baseline. The IMF conducts these major economic reviews of countries called Article 4 consultations, and the IMF's April 2026 forecast for Turkey projected that their massive inflation problem was finally going to decline.
And that entire optimistic forecast from the IMF was anchored to one very specific number, right? Turkey's central bank had a hard 16% inflation target.
Yes. That was their credibility anchor. The whole world was making bets based on the promise that Turkey would hold the line at 16%. Every financial model, every IMF condition, the market's entire expectation was premised on that anchor holding firm.
But then the structural reality of the Iran war hit. This week, Turkey didn't just miss the target. They formally abandoned it.
They did.
They raised their inflation target from 16% to 24% in a single massive adjustment. They basically looked at the upstream cost shocks, the price of energy skyrocketing because the Strait of Hormuz is a mess, and admitted their old target was mathematically impossible.
It is a total capitulation. And it exposes the fragility of Turkey's entire financial structure. The dispatch focuses heavily on Turkey's maturity wall.
Right, the maturity one. Can you explain that real quick?
Sure. Think of a maturity wall like having 5 different massive mortgages on your house, and they're all suddenly due on the exact same Tuesday.
Right.
If the bank won't roll them over, meaning refinance them, you hit a wall and default.
And Turkey has a massive wall of foreign debt coming due.
A huge amount. And they also run a current account deficit, meaning they import more than they export, especially energy.
Hmm?
The plan to refinance that maturity wall and the plan to fund that deficit were entirely calibrated to that 16% inflation target. The whole financial architecture of the country was built for a monetary framework that just ceased to exist this week.
Okay, this is the part that makes my head spin. Going back to the pilot with the Sharpie, how on earth has the global market not repriced this? Turkey just announced their engine is fundamentally broken, and the market is ignoring it.
The market is currently suffering from a lethal combination of momentum and outdated assumptions. Look at what we call the bring-even on Turkish lira carry trades.
All right.
Essentially, investors make complex bets on the Turkish currency holding its value. Right now, those bets are still being priced as if the central bank has credibility. The investor saw the Trump-Xi summit, felt the geopolitical risk drop, and essentially decided to gloss over the fact that Turkey just threw its own steering wheel out the window.
Wow.
They are trading real money based on a baseline that is now a historical artifact.
It's astounding. So,
Yeah.
okay, domestic policy in places like Turkey is failing because of the energy shock. Usually when a single nation is drowning, they reach out to their neighbors, right? They rely on regional alliances and multilateral groups to throw them a life raft.
And that's the normal playbook, yeah.
But our source reveals that these regional safety nets are quietly tearing apart at the exact same time. Which brings us to the Bay of Bengal and India.
Yes. The source highlights 2 crucial signals that arrived this week. If you watch cable news, you might see these as separate, minor headlines. But a sovereign credit analyst reads them as a single, blinding red light about the failure of multilateral backstops.
So let's lay them out. Signal number 1.
Yeah.
BRICS, the massive block of emerging economies. Brazil, Russia, India, China, South Africa, and the others. They met in India this week. And for the first time, they completely failed to produce a joint statement. The dispatch notes this was specifically because of diplomatic fragmentation over the Iran crisis. They literally couldn't agree on a narrative.
That is deeply significant. When a crisis like the Hormuz supply shock hits, you expect a powerhouse like India to serve as a regional convener. You expect them to organize a collective economic defense.
But they can't even get their own bloc to agree on a basic piece of paper.
Exactly. The diplomatic unity is an illusion, and signal number 2 is even more pointed.
Right, the BIMSTEC signal.
Yes, from a group called BIMSTEC. For those who don't spend their weekends reading regional trade charters, BIMSTEC includes Bangladesh, Myanmar, Sri Lanka, Nepal, Bhutan, Thailand, and India.
Right, so what happened there?
Well, this week, the Secretary General of BIMSTEC made a very public statement saying that Bay of Bengal regional cooperation is quote-unquote critical.
Which doesn't sound that crazy on its face.
Right, but when a diplomatic official uses a word like critical in a public dispatch, it's not a polite suggestion for a future meeting, it's a distress signal.
Oh.
To understand why, look at a map. The energy supply chains for these frontier economies traverse the exact corridor that is currently paralyzed by the Hormuz conflict and the Iran war.
So the physical fuel just isn't arriving.
And that breaks the financial models. Take Sri Lanka. They are currently surviving on an extended fund facility program from the IMF.
Basically a financial life support system with very strict conditions.
Exactly. Bangladesh also has specific credit metrics they have to maintain to keep their economy solvent. Both of those financial life support systems were modeled by the IMF on the assumption that regional energy trade would remain stable and cooperative.
The IMF assumed that if things got tough, these countries would help each other out, not turn on each other.
But the BIMSTEC Secretary General is sounding the alarm right as BRICS fails to even write a joint statement. It proves that the multilateral architecture, the safety net, has demonstrably failed. When the pressure hits, the cooperation evaporates.
The backstop is just gone.
It's gone.
And yet the dispatch notes that the bond spreads for Sri Lanka and Bangladesh, like the real-time measure of how risky investors think those countries are, they haven't moved. The liquid market, the day traders are completely ignoring the distress signal.
Because they're looking at the summit.
Right. But the author points out one group of investors who are paying attention, and it's happening right in India. We are seeing a massive cool down, not just in the liquid stock markets, but in private equity.
This is a vital distinction that explains the severity of the situation. Liquid portfolio markets, your everyday stock and bond trades, can fluctuate wildly based on a single headline or a good feeling after a political summit. You can buy a stock on Monday and sell it on Tuesday.
Right, but private equity is a completely different animal. That's sophisticated capital that gets locked in for 5, 7, maybe 10 years. If they're committing money, they're making a long-term bet on the structural reality of a country. So if private equity is pulling out of India,
Then it is a durable structural reassessment of India's multi-year trajectory. It's the smart money quietly heading for the exits while the retail market is distracted by the photo ops in Beijing.
oh well.
The private equity funds realize what the IMF hasn't updated yet. The IMF's April 2025 baseline for India's economy is materially outdated against a balance of payments trajectory the fund literally never modeled for.
Because they didn't plan for a world where regional backstops fail this spectacularly.
Exactly.
It paints such a chilling picture of the global system. Every single safety net domestic policy in Turkey, regional alliances in the Bay of Bengal, multilateral lenders like the IMF, and that global liquidity reservoir in Japan, they're all fraying at the exact same time.
Yeah.
And the broader market is just cheering because two world leaders shook hands.
Which is why the author of this dispatch ends with one of the most remarkably accurate metaphors for financial analysis I've ever heard. They wrote, "Every map carries the date on which it was drawn."
Oh, man. Let's unpack that because it ties everything we've talked about together perfectly.
It really does.
The IMF's April 2026 forecasts, the bond pricing models, the assumption of stable supply chains, all of that is the map the market is using right now to navigate.
Yes, and look at what that map assumes. It assumes Japanese yields would normalize slowly, leaving the global liquidity reservoir intact.
Right.
It assumes Turkey's 16% inflation anchor was a mathematical certainty. It assumes the multilateral architecture supporting South Asia would function during a crisis.
But the map was drawn before the Strait of Hormuz crisis entered its structural phase.
Oh.
The map was drawn before the fire started.
Exactly. The market's massive collective error this week. The reason bond spreads tightened and stocks rallied after the Trump-Xi summit is that they confused the date of the summit with the date of the map.
They looked at their calendar, saw the May 15th diplomatic détente, and thought, okay, the territory has been secured.
But neither the summit's communique nor the IMF's April map reflect the 3 simultaneous breaks that actually occurred this week. Turkey publicly abandoning its target, Japan's active repatriation of capital, and China's total failure to restore the physical flow of fuel.
The territory has completely changed. The mountains have moved, the rivers have dried up, but the investors refuse to look up from the old map. The dispatch puts it so bluntly. Bonds aren't just mispriced right now. They are mispriced with institutional confidence.
And that phrase should send a shiver down the spine of anyone managing risk.
Yeah.
Institutional confidence is the exact psychological condition the market requires before it corrects with absolute violent force.
Because everyone is on the exact same side of a sinking boat, totally confident that it's a submarine. It is a masterclass in how massive, highly educated institutions can sail full speed toward an iceberg. They have all the data. They see the distress signals from BIMSTEC.
They do.
They have the explicit communication from Japanese fund managers pulling money out of the U.S. They literally watched Turkey's central bank cross out its own inflation target with a Sharpie. But because the map in their hand says the water is clear, they just keep the engines at full throttle.
It highlights why critical thinking and a relentless focus on physical, structural reality is the only way to survive in a world that is just overloaded with diplomatic noise.
Yeah.
The narrative can defy reality for a week, a month, maybe a year, but the physical reality always wins in the end.
It always does.
Yeah.
You can't print physical fuel, and you can't handshake away a maturity wall. Which leaves us with a pretty heavy thought to chew on as we wrap up this deep dive.
Definitely.
We've spent this entire time looking at how institutional confidence is currently masking all these structural failures across the globe. But if the massive funds, the central banks, and the multilateral institutions are dead wrong, what happens to individual investors, to pension funds, to everyday portfolios when that collective illusion finally snaps?
It's the multi-trillion-dollar question.
It is, and more importantly, if the map everyone is using to navigate the global economy is completely obsolete, where do you find your true north before the house burns down and the market violently corrects? Keep your eyes on the physical reality, everyone. Thanks for taking this deep dive with us.